Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about JLMAG Rare Earth Co. Limited annual report. JLMAG Rare Earth Co. Limited offers a diverse range of businesses and services related to rare earth permanent magnetic materials. The company's products cater to various industries, including new energy vehicles and auto parts, where they provide NdFeB-PMS for improved performance. In addition to the automotive sector, JLMAG Rare Earth Co. Limited also supplies its products to other fields such as wind power generation, 3C, computer, communication and consumer electronics, products, robotics, industrial servo motors, energy-saving elevators, and rail transit systems. The company's expertise in rare earth permanent magnetic materials has made it a significant player in the global market. The company's extensive range of services includes research and development, production, and sales of its products. With its headquarters in Guangzhou, China, JLMAG Rare Earth Co. Limited has established itself as a leading provider of rare earth permanent magnetic materials globally. JLMAG Rare Earth Co. Limited market capitalization of $50 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that JLMAG Rare Earth Co. Limited holds a significant advantage in their industry. JLMAG Rare Earth Co. Limited trades at a lower price-to-earnings ratio of 33 times and a higher price-to-book ratio of 3.08 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 42% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline are multifaceted and influenced by a range of internal and external factors. On one hand, revenue growth is primarily driven by sales expansion, increase in trade receivable scale, and effective control over raw material costs. For instance, the Chinese mainland experienced significant revenue growth due to increased sales, while effective management of raw materials helped maintain profitability. On the other hand, revenue decline is often attributed to poor collection of trade receivables, failure of customers to make timely payments under contracts, and decrease in sales volume or prices. The geographic variations in revenue growth and decline are also noteworthy, with some regions experiencing higher growth rates than others. Customer-specific factors, such as changes in customer A's sales, can also contribute to revenue growth or decline. Effective control over raw material costs and inventory management are crucial for maintaining revenue growth. Moreover, economic conditions, external environment, and trade policies can significantly impact revenue growth or decline. By considering these various factors, businesses can better understand the drivers of their revenue growth or decline and make informed decisions to mitigate potential risks and capitalize on opportunities. The net income of the company underwent significant fluctuations between 2023 and 2025. Initially, it decreased by 48% from 2023 to 2024, but then increased by 147% from 2024 to 2025. This substantial increase was largely driven by a rise in market prices of major rare earth raw materials. Furthermore, the company's steady growth in product sales volume and effective control over raw material costs contributed to its improved overall gross profit margin. In terms of profit margins, there was a notable decrease from 2023 to 2024, but an even more significant increase from 2024 to 2025. The profit margins increased by 116% during this period, indicating a substantial improvement in the company's profitability. This upward trend can be attributed to the company's ability to effectively control raw material costs and improve its overall gross profit margin. The company's financial performance indicates a significant improvement in its ability to generate cash. According to the provided information, the company has successfully transitioned into a positive operating cash flow position. This is evident from the net cash generated from operations, which stands at RMB 417,172. This achievement is a crucial milestone for any business, as it signifies that the company's core operations are generating sufficient funds to cover its expenses and invest in growth initiatives. The shift towards positive operating cash flow suggests that the company has implemented effective financial management strategies, allowing it to optimize its resources and improve its overall financial health. The company's debt level has undergone significant changes over the past year. Initially, it increased by RMB 111.3 million from RMB 3,071.6 million to RMB 3,282.9 million. However, a more substantial increase was observed later on, with total debt rising from RMB 364,290 million to RMB 3,142,105 million. Furthermore, non-current liabilities, debt, increased by RMB 26,639,000 from 2024 to 2025. Additionally, interest-bearing bank borrowings saw a notable increase from RMB 413,489 in 2024 to RMB 680,512 in 2025. In terms of interest expenses, there has been a significant rise as well. Finance costs increased by RMB 35.2 million, 75.37%, from RMB 46.7 million in 2024 to RMB 81.9 million in 2025. Interest expense also saw an increase from 0 to RMB 19,467. However, interest expenses for 2025 are not provided for one of the comparisons, indicating a possible discrepancy or lack of data. Management's vision for the company is centered around becoming a global leader in the REPM industry. This goal is driven by technological innovation, which is seen as the core driver of growth. To achieve this vision, the company plans to continue investing in research and development (R&D) and capacity building. In addition to R&D investments, management aims to diversify raw material supply, broaden product mix, and strengthen production capabilities. This will enable the company to better meet customer needs and tap into key segments of the industry chain. Furthermore, the company plans to prioritize process optimization, equipment upgrades, automation, digitalization, and intelligent manufacturing to enhance operational capability. The company's strategy is focused on driving growth through innovation and capacity building. By investing in R&D and diversifying its supply chain, the company aims to increase efficiency and competitiveness. The emphasis on technological innovation and process optimization suggests that management is committed to staying ahead of the curve in terms of industry trends and best practices. Concerns about inventory buildup and supply chain disruption have been raised in various sections of the report. The data suggests that there has been an increase in raw materials, work in progress, and finished goods inventories over the past year, indicating a potential buildup of stock. This trend is particularly evident in the organics segment, where inventory levels have increased significantly. Such a buildup can lead to inefficiencies, wasted resources, and reduced competitiveness in the market. Furthermore, the export regulations on rare earth elements pose a significant threat to supply chain stability, as they may disrupt the flow of essential materials. The potential for supply chain disruption is a pressing concern, given the critical role that these elements play in various industries. The impact of such disruptions can be far-reaching, affecting not only businesses but also the broader economy. Therefore, it is essential to address these concerns and develop strategies to mitigate their effects. That concludes the financial summary for JLMAG Rare Earth Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.